In preparing a balance sheet at the 30th of June, the owner of a small business was unsure how to treat the item creditors. The firm's accountant informed the owner that creditors should be classified as a liability. Explain whether the accountant is correct and justify your opinion with reference to the definition of a liability. Let's look at what a creditor is first of all. A creditor is another party that sells our business a good or a service, so it could be stock for example, and gives us an invoice. And the reason they give us an invoice is on the day that they sell us the goods, they don't actually ask for money, they put it on credit. And what then happens is there's now a promise to repay from our business to the creditor. At some point in the future, it could be a day, a week, a month, 6 months, the business will eventually repay that creditor with cash. Looking at whether that is a liability, the definition of a liability is really important. So it's got 3 parts to it. The first part is a liability is a present obligation. It must arise from a past event. And lastly, it must result in an outflow of future economic benefits from the entity. So what we're going to do is figure out, does the creditor selling us goods on credit today, does that meet the definition of a liability? So let's look at the part about the goods with the invoice going to our business. That is actually going to be our second criteria there, called arising from past events. That's actually just a fancy way of saying in business there are transactions. Those transactions represent a past event between businesses. So in this case, when the creditor sent those goods with an invoice to our business, that was a past event. So we can tick off our first criteria of a liability. Our next criteria we'll look at is there a present obligation? So what that means is once the business got those goods with the invoice, there's now a legal promise to repay the creditor. We can't legally back out of that. At some point we're going to have to repay. So that is actually the definition of a present obligation. Lastly, will this result in an outflow of future economic benefits from the entity? Will something leave our business and go to the other party? And in this case it will. At some point the business will repay that creditor with cash. That cash is actually an outflow of economic benefits. The firm's accountant informed the owner that creditors should be classified as a liability. So what we've done now is actually looked at that, and we can now answer the question, is the accountant correct? And we can justify it with the definition of a liability. So we've got 4 marks here. So 4 marks means we need to do 4 things. The first thing we're going to do is actually answer the question which says, explain whether the accountant is correct. We're going to identify a liability and we're going to also define and relate. So let's look at our answer. The first thing we're going to do is answer that question and say, yes, the accountant is correct. Creditors are a liability. Now let's get on to our defining and relating. So we've answered the question, we've identified the element as a liability. What is the definition? So what we'll do is define and relate at the same time. So we'll say that the first thing part of a liability is a present obligation. And in this case, the obligation is to repay the creditor the amount owed. Secondly, was there a past event? There was. In this case, the firm purchased goods on credit. And lastly, will it result in an outflow of future economic benefits? It will. In this case, the firm will pay cash to the creditor. So 4 marks for 4 things. Our first mark was for answering the question. Our second mark was for the first part of the liability definition and relating it. And then we had a mark for the past event component. And then we had a final mark for the outflow of future economic benefits. So 3 marks for defining and relating and 1 mark for answering that question.